For the longest time, one of the smartest moves for a conservative investor was picking a debt fund over a fixed deposit purely for the tax benefits. But what if I told you that advantage is now completely gone? A recent tax change has totally rewritten the rules, and in this explainer, we're going to give you the new, clear guide to making the right choice for your money.
So this is really the big question we're tackling today. When it comes to taxes, is there any advantage left for debt funds over FDs? I mean, the answer used to be a very clear yes, but things are, well, they're very different now. Let's find out if this race is truly over.
The real game changer here was the Finance Act of 2023. This one piece of legislation basically just reset the entire board. All those old assumptions we had about how these two popular options stack up on taxes, they've been thrown right out the window for any new investments.
Okay, so let's dive right into our first section and really get a handle on this new tax reality. We're going to see exactly how the government created what is now, for all intents and purposes, a level playing field from a tax point of view.
This slide just shows the shift so perfectly. Before April 1st, 2023, debt funds had a massive advantage. If you held one for over 3 years, your gains were taxed at 20%. But, and this is the key part, with a crucial indexation benefit. This basically adjusted your purchase price for inflation, which meant you paid way less tax. But now, for any new investment, that benefit is just gone. All your gains, doesn't matter how long you hold the fund, are just added to your income and taxed at your regular rate. Sound familiar? It should, because that's exactly how a fixed deposit is taxed.
So, talking about it is one thing, but let's put some actual numbers to these new rules. I think seeing the math is really the best way to understand the real-world impact of this change.
And here it is. This is where it all just clicks into place. Look at these numbers. Let's say you invest 1 lakh for 4 years, and both the FD and the debt fund earn 7% a year. The total gain is identical, 31,080 rupees. Now, for someone in the 10% tax bracket, the tax on the FD is simple, 3,108 rupees. And under the new rules for a debt fund, it's exactly the same. The tax paid is 3,108 rupees. The bottom line is, well, it's a mirror image.
So the most important takeaway is this. For any new money you invest today, the tax advantage a debt fund once had over a fixed deposit is now zero. Zilch, it's gone. And what this means is that tax should no longer be the main reason you pick a debt fund over an FD. The decision now has to be based on something much more fundamental.
All right, let's move on, because with tax off the table as a differentiator, the real difference comes sharply into focus. And that difference is risk. For any conservative investor, understanding this is now more important than ever before.
This slide lays it out perfectly, doesn't it? With a fixed deposit, it's so simple. You have zero market risk. Your principal is safe, your interest is guaranteed, period. But with a debt mutual fund, you are taking on market-linked risks, even if they are lower than in stock funds. Let's just quickly break down the 3 main types.
Okay, first up, there's interest rate risk. See, a debt fund holds a bunch of bonds. If the RBI decides to raise interest rates, then any newly issued bonds will offer a better return. This makes the older bonds that your fund is holding a little less attractive, and their market price can actually fall. And that means the value of your investment, the fund's NAV, can go down in the short term.
Second is credit risk. This one's pretty straightforward. It's the risk that the company or government entity that issued the bond just can't pay its debts back, a default. Now, fund managers try really hard to invest in high-quality bonds, but this risk is never truly zero in a debt fund. In a bank FD, on the other hand, this specific risk of default is pretty much non-existent for you, the investor.
And finally, there's liquidity risk. Imagine a moment of market panic, where lots of investors rush to sell their units all at once. The fund manager might be forced to sell bonds at a big discount just to get cash quickly. This fire sale, as they call it, can really hurt the value for all the other investors who are still in the fund.
Okay, so we've established that the tax playing field is level, and the risk profiles are fundamentally different. So where does that leave us? Let's get to the verdict. I put together a really simple checklist to help any conservative investor figure out if an FD should be their first choice.
All right, an FD is the clear winner for you if you find yourself nodding along to these points. First, if you demand absolute 100% safety of your principal and you just can't stomach any ups and downs, the FD is your answer. Second, if you're saving for a fixed goal, maybe a wedding next year, and you need to know the exact amount you'll have, that guaranteed return of an FD is what you need. Third, if you simply want to avoid the headache of tracking markets and economic news, the FD offers just unmatched simplicity. And finally, if your investment timeline is short and certainty is totally non-negotiable, the FD's predictability just trumps everything else.
So, in a strange way, these new tax rules have actually made things simpler. The choice isn't about complicated tax math anymore. It's all about your personal comfort with risk versus your need for certainty. It all comes down to one simple question. What job are you hiring your money to do? Is its job to be a fortress, absolutely safe and predictable? Or are you hiring it to be a sailor, willing to navigate some market waves for the chance of a slightly higher but not guaranteed return? Your honest answer to that will tell you exactly where your money belongs.